everyone, I'm Alex Larkman and I'm here today to have a chat with Steve because the Forager Australian Shares Fund and therefore the Forager business turned 10 this year. Hi Steve.
Hey Alex.
So I've been with Forager for over half of those 10 years. It's coming up to 6 years now. So we are going to run through some questions and some memories of the past 10 years, hopefully making it up to 10 questions. So, right, ready to kick off?
Let's go.
So, first question, do you remember the launch of the fund?
I sure do. I mean, it's a little bit of a blur because it's so far long ago now. I remember the first roadshow we did, that's for sure. We traipsed all over the country, down to Wollongong, Newcastle, all the way up to northern Queensland, and some pretty small meetings with clients back then. We raised about $10 million for the fund back then, which seems like a small amount of money now, but back then we were pretty happy with the first fundraising.
Great. Would have been interesting to be at one of those early meetings, I think. And why did you actually start the business to begin with?
Like a lot of things in our business history, it wasn't part of any grand business strategy. This was the middle of the financial crisis in 2009. There were lots of cheap stocks out there. There were actually a few businesses going into receivership, and our first thought was, can we put together some little special purpose funds to try and buy some of these assets that were going into receivership? That all proved a bit too complicated, but we did work out that it wasn't that hard to start a fund. And there were lots of small cap illiquid stocks then that were trading at very attractive prices that we couldn't recommend in the Intelligent Investor newsletter, which is where Greg and I were working at the time. So we started the little funds management business underneath the umbrella of Intelligent Investor. I put in some of my own money to own a bit more of that business, and that's how we kicked things off. And really the pitch to clients was, because we had thousands of subscribers to that newsletter back then, we could only really invest in larger, more liquid stocks, and there was a whole part of the market that we were interested in and excited about that was smaller. So the aim of the fund was to do that part of the market for clients that we couldn't do in the newsletter.
Sounds interesting. And so who were the first people to actually join that business?
We actually had a beautiful little office in the early days. It's gone downhill on that front since then, but we had I shared an office with a couple of other fund managers down in Rushcutters Bay. We wanted to separate ourselves from the rest of the Intelligent Investor team. I used to run that business, so I was constantly getting dragged back in to fight fires and solve problems. So we set up a new office, and it was down in Rushcutters Bay, had a nice big balcony and lots of fresh air. We could open up the windows. And the first person to join me was Kate Cosgrove, now Kate Ferguson, probably a familiar person to quite a few of the older clients watching this video. Been with us sort of back and forth across most of that journey and working with me for many years before that. And then Matty Ryan was the first analyst to join us on the Australian fund. He came basically from an engineering degree, did his CFA while working for me, was very interested in investing in stocks and worked with us on that fund for the next 5 years.
Yeah, and I crossed over with Matt for maybe 2 to 3 years, and great person to work with. But I actually hear you threatened to sack yourself after a couple of years. How close were you really? Yeah,
the first couple of years weren't great, that's for sure. We made a couple of disastrous investments. One in particular, it was called Photon Group back then, a marketing services agency. Bizarrely, we still own this stock. It's now called a Nero, and it's been the best performer by a long way in the Australian fund this year. So this year, we've made a lot of money out of it, but back in 2010, it was a disaster. We haven't had a significant percentage of the portfolio in it. We had some other things going very well at the time. I brought a couple of stocks across from my research days at Intelligent Investor in the infrastructure space, Macquarie Airports and Spark Infrastructure. So there were some offsetting things, but we were probably 10% down after 18 months in that fund, and the market had gone up, and a lot of people were questioning why they'd invested in a fund with a fund manager who didn't have a track record. So, you know, I have always said we are here to generate outperformance for people, and I said at the time that if things don't improve, then we might as well find something else to do with our lives. And fortunately, they did turn around quite quickly. How close was it? Who knows? We didn't have to worry about it in the end. But the client base were actually very supportive at the time and told me to wake up to myself and get on with making the money.
Oh, that's good to know. And I'm glad that they did cause you to continue with the fund, because we wouldn't be where we are now. So after that, the Australian fund had almost 7 years of really great performance. And just want to know, what were the key drivers of success?
I think we improved our process a lot because of some of the mistakes. So the research process became a lot more detailed, a lot more diligent. This concept of checklists, I think, is very, very important. It's very easy to focus on the things you like about an idea. The things that you don't like sort of slip into your subconscious, and you subconsciously ignore them. So we've built up a fair bit of process. I think there was a dose of luck. You know, we invest in a style and in a way that the returns tend to come in a very big way from a small number of stocks, and you never know how it's going to turn up. So, you know, we had a few stocks in the portfolio, RHG, which was the old Rams home loans that performed very, very well for us. And then one service stream that, you know, we owned for 2.5 years, and the business was just doing good results 6 months after 6 months and was growing, and the share price just didn't move for 2.5 years. And we were really sitting there scratching our heads about that one, and then all of a sudden it got a bit of attention from brokers and a bit of attention from other fund managers, and spent the next 3 years going up and up and up from 20 cents a share to, well, trades north of $2 now, and that first 20 cents to $1.20 was fairly quick. So it was really a couple of individual stocks in the portfolio, you know, probably 5 or 6, that drove most of the return over that period. And it was a pretty opportune time to keep recycling it as well, and it's one of the challenges we've faced with constantly rising markets in recent years. But in that 2012 to sort of 2016, we had 2 or 3 pretty big pullbacks. You might even remember a couple of them where the market was down 20% without a lot of news to go with it. There were sectors like mining services that were really, really beaten up, and we were able to sell some of the things that were performing well and recycle that money into stuff that then subsequently performed well as well. So, you know, we promised people lumpy and inconsistent returns, and I think in some ways it would have been better if there were a couple of really negative years in that 7-year run, because it is our style of investing to generate those lumpy types of returns. But, you know, it was 7 good years in a row, and it probably lulled us and some of the client base into a bit of a false sense of security.
It's interesting to hear that the returns came from a small number of stocks, and I certainly remember Service Stream. That took off just about when I joined the business, I think.
Yeah, you were the lucky charm.
And next, Forager launched an international fund in 2013, and it's now actually grown to be as big as the Australian fund. What do you think were the keys to success here?
Well, look, really interestingly, from a business perspective, demand is at least as important as the product itself. So we launched that fund at a time when the Aussie dollar was more than parity with the US dollar. So, you know, we were writing a lot in our Australian fund reports about, you want to be getting foreign currency exposure, you want to own businesses that have got foreign earnings, because we're worried about the dollar and we're worried about the mining cycle. And some of our larger clients came to us and said, we really like that concept, we want to invest some money overseas, but we don't feel comfortable doing that ourselves, and would you start a fund to do that? So, yeah, it was really market demand that led us to launching that fund. And we recruited Gareth Brown across from Intelligent Investor. He was living at Vienna in that time. We recruited Kevin Rose, who was living in the US, to give us some of that international experience. But in terms of the fundraising, we actually raised more money for that fund in a couple of years than we raised in the whole Australian fund's life, because the demand was there for people to invest their money overseas. And I still think, you know, that's been a theme for most of that fund's life, is that it's made a lot of sense for people to get more of their portfolio invested overseas. So I think it was actually more about the demand in the early days. And then, you know, we had again a rough 18-month period. In that fund, it wasn't so much about mistakes that we made in that first 18 months, but the market just ripped dramatically higher. Basically, from the day we launched the fund, I think the market was up 20% or something in the first 6 months, and it took us quite a bit of time to get the money that we'd raised invested, so we missed out on some of those early returns in that fund. And, you know, for most of its life, we've been trying to give the client base something different from index and different from the large blue chip funds out there, and generally that hasn't been the best place to be. Owning big US tech stocks has probably been the right strategy over that period.
Yeah, international markets have definitely performed very well over the past few years, but we'll see what the future holds there. Now, moving on to the past 2 years. So both funds have actually seen some underperformance during those 2 years. What has caused that, and how have you dealt with it after such a good run of outperformance, particularly in the Aussie fund?
Yeah, I touched on it earlier. I think in some ways I wonder whether the 7 years of great performance maybe caused us to be a little bit lax about improving things and making sure that we've got all the resources that we need. And then I think there's been a confluence of events. I think the style of investing that we have, you are going to have periods of underperformance, and we've sort of combined what you would expect to happen once every 3 or 4 years but didn't happen for 8. We've sort of had an excess period of underperformance as a confluence of events have come together. I touched on this with the international fund. It's true here in Australia as well. I mean, the whole strategy has been underperforming, and that's not an excuse for us. We should be able to do much better than the strategy does. But buying unloved, underappreciated businesses, they have tended to get more unloved and more underappreciated over recent years, and the stuff that's growing and doing well has done even better. And that theme hasn't really stopped, maybe a little bit in the past 3 months, but hasn't really stopped over most of the past 10 years. So it's been a pretty big headwind there. And then, as I touched on before as well, there's been a couple of stock-specific mistakes in both funds that have had big impacts on the returns. Again, it comes with the territory. We run concentrated portfolios. We're going to have things go wrong from time to time. It's going to have a big impact on the performance. But I think internally, we've looked at it and said, look, there are things that we can improve and do better as well. And then the final thing that I think has been really important, and it's been a strategic error of mine, is that we've held significant amounts of cash in both portfolios while markets have been performing very strongly. And if I had a strong view 2 years ago that markets were dramatically overpriced and we need to hold cash because markets are going to go down, it would have been more excusable than we've sold stocks, we've got excess cash, and we're just going to wait until we find cheap stocks again to deploy that cash. It's probably been the single biggest contributor, particularly in the international fund over that period, is just the drag of holding a zero returning asset in cash while markets have done very well.
Yeah, well, cash is much lower now. And actually, in late 2019, we have seen a dramatic recovery in the international fund and some positive news out of the Australian fund. Is this a sign of good things to come?
I hope so. I hope so. Look, the funny thing about the style of investing and the nature of our business, you go through sometimes years of very difficult periods and underperformance, and then you get all of the outperformance in a very short period of time in terms of a stock coming good or even a market. We had an election in the UK last week where it was favourable towards markets and towards the UK economy that the Tories won that election, and our portfolio is up a lot just over a few days because we are heavily overexposed to the UK. That's been a lot of suffering over a few years as we found good businesses in those markets that are trading at very attractive prices. They've been paying us dividends for the most part and we've been collecting returns, but the share prices have just gone down and down as that market became uninvestable, and all of a sudden it reverses very, very quickly. So I think to be successful in this business, you actually need to be willing to suffer for long periods of time and then enjoy the short periods of outperformance when they come along. I think that in particular has a long way to run. The stocks in the UK are still, they might be up 20% over a couple of days, but valuations are so much lower than the rest of the world. And I think most people are so dramatically underinvested in the UK, which is a big developed equity market, that I can see, months of good performance out of some of those businesses that we own rather than just a couple of days. We've got that international fund fully invested, so I'm much more optimistic about the portfolio construction that we've got there. On the Australian fund, we've had a takeover for CSG in the past 6 months. I would like to see a lot more of that. I think if you're getting value investing right and you're buying really cheap businesses, then people are going to come along and buy them. And we had a lot of it in the early years of the Australian fund, that we takeovers left, right and centre in the portfolio. And I think if we're doing our job well, you should see more CSGs and takeovers. We've been working hard to get some more liquid, better quality stocks into that portfolio, and the cash weighting is down. I still think that's got a few months or a few more good ideas is probably a better way of putting it to go before I'm feeling the same about that portfolio that I'm feeling about the international fund at the moment. We've got some big weightings there in stocks where good things could certainly happen, and hopefully we get some good results again. We had a really good reporting season through August. I think if we get another one through February, businesses like Macmahon, for example, that are actually performing very well and the share price hasn't been doing much, it gets hard for people to ignore them. Like we saw with ServiceStream all those years ago, if you put 6 good results together, it gets pretty difficult for the market to ignore it. So look, I hope so. I don't, it's been a very difficult period for us internally. It's been a difficult period for the clients, and it's great to see some good returns towards the back end of this year. And some of that hard work and internal work that we've done on process and team development and things paying off.
Oh, well, let's keep our fingers crossed and keep our eyes on the UK market and the reporting results here. So last question, and then one fun question to make it up to 10, if we're sitting here in 2030, what do you hope Forager will be celebrating as its 20-year anniversary?
Well, outperformance above all else. I think that's why we all come to work. We want to deliver returns to our clients, and we do our roadshow every year. We have a pretty close relationship with a lot of our clients, and I want to see those people live a good retirement and pass on their inheritance to their kids and whatever else it is that they want to achieve financially. We want to be a part of that, and we want to be an important part of their portfolio. I said it a lot at the roadshow last year. I think it's really important that we can deliver returns when other asset classes in their portfolio are not necessarily doing so. I want to deliver on that promise. I'd like to see the business successful and all the people that work here grow and achieve success in their career and get well rewarded for that as well. It's been a difficult period for client. I think it's been a difficult period for everyone who works for the business as well, and I would really like to see success for them and for shareholders. I've said all along, we don't want to be a giant business, but I think if we can deliver the returns over the next 10 years, then it's going to be bigger than it is today, and hopefully that rewards the long-term support that we've had from the client base and the staff and the shareholders in this business as well.
Great. Well, let's hope we are still sitting here in 2030. And last fun question is, what is your most memorable work-related trip, either in Australia or overseas?
Yeah, well, particularly since we launched the international fund, Gareth and I have had some good trips around the world. It's a part of the job that I liked a lot early on. It gets a bit fatiguing after doing a lot of it, but we've been to a value investing conference in a place called Trani in Italy a couple of times. There's been a couple of good ideas come out of that conference, I promise you, but it is one of the most beautiful places in the world. It is extremely cheap. It's a very Italian, it certainly was back then. I think it's become a bit more of an international tourist spot, but at the time it was where all the locals went for their holidays, people sitting on the rocks, going for a swim every day, catching a few octopus in the Mediterranean, and eating amazing food and getting some good stock ideas while we're there. So that's certainly been my favourite trip that we've done.
Very nice. Some nice trips as well as business and stock searching. Well, I think that wraps up the 10 questions for the 10-year anniversary of the Australian Fund and Forager. Thanks for tuning in, and see you next time.